Earnings management is a term that often gets thrown around in business discussions, but what does it really mean? Imagine you're a company, and every quarter you're under immense pressure to show strong financial results. Your investors are watching closely, analysts are ready to pounce on any sign of weakness, and your own bonuses might depend on hitting those targets. In this high stakes environment, the temptation to manipulate your financial statements can be overwhelming. But let's break this down. What is earnings management, and why should we care? At its core, earnings management involves using accounting techniques to influence a company's financial reports. Think of it as a way to paint a more favorable picture of a company's performance than might be warranted. This can be done through various methods, such as changing how revenue is recognized, adjusting expenses, or even manipulating reserves. Some of these practices are perfectly legal, while others can cross the line into fraud. So, why is it crucial to understand earnings management? First and foremost, it's about informed decision making. Investors rely on financial statements to gauge whether a company is a sound investment. If those statements are manipulated, investors might be misled into thinking a company is performing better than it actually is. This can lead to poor investment decisions and ultimately financial losses. But it's not just individual investors who are affected. When many companies engage in earnings management, it creates a distorted view of the overall economy. This can have far-reaching impacts, influencing government policy decisions, consumer confidence, and even the stability of the financial markets. Now, let's talk about the legal implications. While not all forms of earnings management are illegal, some certainly are. Companies that cross the line into fraudulent practices can face severe penalties from regulatory bodies like the Securities and Exchange Commission. This can include hefty fines, sanctions, and even criminal charges in extreme cases. Moreover, companies that engage in earnings management risk damaging their reputation, which can have long-term consequences for attracting investors and customers. Interestingly, not all earnings management is done with malicious intent. Sometimes, companies might engage in these practices to manage expectations or smooth out earnings over time. For instance, a company might adjust reserves to avoid showing large fluctuations in earnings from quarter to quarter. While this might seem like a reasonable strategy, it's essential for companies to be transparent about these practices. Investors deserve to know what's happening behind the curtain. Now, let's delve into some common techniques used in earnings management. One of the most notorious is the big bath technique. This is where a company takes a big hit in one period, often by inflating expenses or write-off, so that future earnings can look better by comparison. It's a way to clear the slate and make the future look brighter, but it can mislead investors about the company's actual performance. Then there's the cookie jar reserves technique, where companies intentionally overestimate expenses during good years and then dip into those reserves during tough times. This allows for earnings smoothing, presenting a more stable financial picture over time. On the surface, it might seem harmless, but it obscures the true financial health of the company. Another method is the operating activities technique, which involves timing revenue and expenses to flatten out spikes and drops in earnings. This might mean deferring a sale to the next quarter or accelerating expenses to balance out high revenues. Again, it's about creating a smoother financial narrative, but it can mislead investors about the company's actual performance. The materiality technique involves misstating or omitting accounting facts to alter financial accounts. This can lead to illegal and fraudulent financial reporting, which can have severe repercussions for a company and its investors. And let's not forget the revenue recognition technique, where companies manipulate when they recognize revenue to boost current earnings. This can be particularly tricky as it can lead to significant discrepancies between reported and actual performance. To illustrate how these techniques play out in real life, consider a company that's just shy of meeting its quarterly earnings target. In a bid to impress investors, it might delay recognizing certain expenses until the next quarter. This creates an inflated earnings report for the current period, misleading investors about the company's financial health. Or take a company that has enjoyed a string of profitable years but is now facing declining sales. By dipping into its cookie jar reserves, it can present a more consistent earnings growth story, masking the reality of its financial struggles. While this might keep investors happy in the short term, it ultimately obscures the true state of the company's finances. So, what drives companies to engage in earnings management? One significant factor is pressure from investors and analysts. If a company consistently fails to meet earnings targets, it risks a declining stock price and reduced investor confidence. This pressure can create a strong incentive to manage earnings, even if it means bending the rules. Executive compensation structures also play a role. When bonuses are tied to financial performance metrics like earnings per share, executives may feel compelled to engage in earnings management to boost their pay. This creates a conflict of interest as executives prioritize their financial gain over the company's long-term health. Accounting standards and regulations can contribute to earnings management as well. While these standards aim to ensure consistency and transparency, they can also create loopholes that companies exploit. Aggressive interpretations of accounting rules can allow companies to present a more favorable financial picture than warranted. Competitive pressures can further exacerbate the issue. Companies in highly competitive industries may feel compelled to report strong financial results to maintain their market position. This can lead to a culture of earnings management, where the drive for short term gains overshadows long term sustainability. Corporate culture plays a crucial role in shaping a company's approach to earnings management. Companies that prioritize short term financial results over long term value creation are more likely to engage in these practices. A culture that values transparency and ethical behavior can help mitigate the risks associated with earnings management. Now, let's address the elephant in the room. Is earnings management illegal? While not all forms are illegal, those that involve intentional deception can lead to severe consequences. Companies that misrepresent their financial results can face legal action, reputational damage, and financial penalties. The SEC actively investigates and punishes companies engaging in deceptive practices, and shareholders may pursue legal action for losses incurred due to misleading financial statements. When does earnings management cross the line into unethical territory? It becomes unethical when it misleads investors or hides financial difficulties. For instance, if a company uses aggressive accounting practices to create a facade of financial health, it can deceive investors and creditors alike. Additionally, when management engages in earnings management to meet performance targets, it raises ethical concerns about integrity and accountability. So, who's responsible for detecting earnings management? Primarily, it falls on the company's management and board of directors. They are tasked with ensuring transparent financial reporting and compliance with accounting standards. Auditors also play a crucial role in verifying the accuracy of financial statements and identifying potential areas of concern. Regulatory bodies like the SEC are responsible for enforcing securities laws and investigating potential fraudulent practices. Investors also have a role to play in detecting earnings management. By analyzing financial statements and monitoring performance over time, they can identify potential red flags, such as sudden changes in revenue growth or significant fluctuations in expenses. Ultimately, earnings management has both beneficiaries and victims. Company management may benefit in the short term, but investors, employees, and the broader economy can suffer significant consequences. The practice can undermine trust in the financial system, leading to decreased investor confidence and potential economic instability. The potential consequences of earnings management are significant. Legal and regulatory penalties can result from fraudulent practices, damaging a company's reputation and eroding trust among investors. Additionally, while earnings management can create short-term gains, it may ultimately lead to decreased shareholder value and increased financial distress if underlying problems remain unaddressed. In conclusion, understanding earnings management is essential for anyone involved in the business world. By recognizing the techniques and motivations behind earnings management, we can foster a culture of transparency and integrity in financial reporting. Whether you're an investor, a company executive, or a regulator, being informed about earnings management can help you make better decisions and protect your interests. The bottom line is that transparency and honesty are key to building trust and ensuring the long-term success of our financial markets.